So we're looking at a piece that presents a really aggressive bullish case for CAPR Therapeutics, or CAPR.
Right.
It argues the recent 15% stock drop, which was caused by a stock offering, is actually a golden opportunity because it's backed by some pretty extraordinary phase 3 data for their Duchenne drug, deramyocel.
And some very high analyst price targets. No, that frames it perfectly. The core idea here, the thesis, it's really powerful. I mean, you've got a real scientific breakthrough.
A huge opportunity.
A huge financial opportunity. But, we immediately run into a pretty significant issue right at the start. The overall analytical credibility of this material, it's just weakened by the very aggressive, almost promotional tone.
Okay, so you mean the language, the high-energy trading psychology.
Exactly.
So there's this excitement, this rebound narrative. But how does that energy, the all caps, the emojis, phrases like crashed and golden opportunity, how does that actually impact the credibility of the analysis?
Well, it creates what I'd call a cognitive mismatch. The material is discussing what could be a life-changing standard of care for patients with Duchenne muscular dystrophy.
Right.
We're talking phase 3 results showing skeletal progression slowed by 54%. Cardiac function preserved by 91%. I mean, these are monumental numbers.
They're transformative in the medical field, absolutely.
In that context, the breakthrough itself should be the story.
It has to be. And the financial opportunity is the logical conclusion of that story.
I see. But when you present those facts using language for day traders, bear trap, smart money, focusing on short-term chart stuff, it just dilutes the seriousness of the findings.
It might cause some people to tune out.
A sophisticated analyst, a due diligence professional, they might just see this as speculative hype, not robust fundamental analysis. The tone needs to signal that the author gets the gravity of what's happening here.
But couldn't you argue that using that kind of high-energy language is a way to signal the target audience? Maybe it's for someone specifically looking for that high-leverage swing trade, and institutional credibility isn't the goal.
You could, and it absolutely does target a specific group. But if the goal is to convey the long-term thesis that supports a $60+ price target, the presentation has to rise above that daily noise.
Okay.
We need to recalibrate the tone. The sheer scale of the clinical success should be what drives the analysis, not the mechanics of a short-term trade setup.
Right. Making the drug the driver and the trade the execution strategy. That's a key distinction. So, let's talk about some specific, actionable ways to do that, to shift the tone.
The easiest fix, and probably the most impactful, is the title. You have to replace the hype.
Get rid of the caps and emojis.
Yeah. Instead, use phrasing that elevates the fundamental win. Something more rigorous, like post-dilution assessment, CAPR's deramyocel breakthrough and path to commercialization. That immediately tells me this is serious analysis.
That title alone just completely shifts the focus from a trade to the operational reality. It sets a totally different expectation.
It does. And then there's a point about the high short interest, right? Around 35%. And the low float. These are powerful stats.
Very powerful.
But they need to be framed strategically. They should be presented as a significant, a secondary accelerant, the thing that makes the move toward those $60 targets explosive, not the primary reason for the investment itself.
So the science is the fuel.
And the short interest is the nitrous. Exactly. So in that intro section, instead of the aggressive hook, elevate the phase 3 data, that 54% slowing of progression. Make that the bedrock of the whole opportunity.
That's a strong move. It establishes credibility from the first paragraph. You're justifying the financial risk by first removing the scientific risk.
Precisely. If you want to attract sophisticated capital, the report has to look like something sophisticated capital would actually read.
Which, brings us neatly to our second point. It's directly about that stock drop in the financial story. The report makes a really strong case that this was a good dilution.
Right, that it removes bankruptcy risk. That's the pivotal argument, because dilution is, it's usually not a good thing.
So the argument is that the offering raises the millions needed to file for FDA approval to commercialize the drug?
And takes bankruptcy completely off the table. It transforms the whole financial picture for them.
It's the classic narrative, right? A small short-term cost for a huge long-term benefit.
Yes, but here's the weakness. To really solidify that bullish idea, the analysis has to give more specific, more quantitative justification for why this is a good dilution.
It can't just be a statement.
No. The report identifies the offering as the cause for the drop, which is correct, but then it leans on this generalization. Biotech companies always raise cash after good news.
Which isn't nearly rigorous enough for this kind of high-stakes claim.
It really falls short of a deep dive. The argument that it funds the BLA filing and commercialization, it's missing the specifics. How much was raised? What's the estimated cost for the next, say, 12 to 18 months?
And for people who aren't deep in the regulatory side, filing a BLA, a biologics license application, that means they're moving past trials and into the final paperwork phase, right? Before any kind of FDA approval or sales can happen?
Exactly. And that process, along with building up pre-commercial activities, requires a ton of capital.
It's incredibly expensive.
It is. So if the claim is this dilution de-risked all of that, we need the numbers to prove it. The analysis identifies the risk reduction, but it doesn't really show its work. It doesn't prove the risk is covered.
So the suggestion here is to anchor that de-risking claim in hard, estimated financial data.
Precisely. The report has to give some context on the company's quarterly cash burn rate compared to the capital they just secured. The goal is to show that the millions they raised are actually sufficient to hit those milestones.
It's about turning an optimistic prediction into a validated financial fact. That's what gets institutional interest.
Yes.
So how do we actually do that? How do we weave those numbers in to make the argument rock solid?
Okay, so first, if it's public, state their gross proceeds from the offering. That's your total cash injection.
Step 1.
Second, you contextualize those funds. Reference the estimated capital needed for the BLA submission and maybe the first year of commercial prep for Durami Alcocel. You need to show the projected use of that capital.
So you're comparing the new cash against the known expensive milestones coming up.
And maybe the most important part, compare their cash position now, post-offering, against their estimated quarterly burn rate. Project the financial runway.
So the reader has no doubt.
Right. The analysis could say something like, factoring in the anticipated Q4 burn of $15 million, this offering provides an estimated 18-month runway, securing funding past the anticipated FDA approval date. Now that is a powerful quantified argument for a good dilution.
That really does transform the argument from just an assumption to a calculated outcome. It strengthens the whole thesis. Okay, let's move on to the structure of the report itself. How the fundamental analysis connects to the tactical trade.
Right, and this is the final major opportunity here, I think.